Let's take you into a global financial story that's unfolding quietly but powerfully. A new gold rush 2.0, led not by consumers or investors, but by central banks. Why are the world's top and most powerful monetary authorities hoarding gold at record levels? Let's break it down. Let's look at the pace of the rise in gold prices to begin with. Now, the rise in gold prices is not new, but the tempo has shifted. After the US abandoned the gold standard in 1971, it took nearly 38 years for gold prices to hit a $1,000 mark, a milestone finally reached in March of 2008 during the global financial crisis. The next leap was quicker. Gold doubled to $2,000 in 2020, August 2020, fueled by the economic uncertainty of the COVID-19 pandemic. That took 12 years. But the pace has since accelerated dramatically. On March 14, 2025, this year, spot gold prices broke through the $3,000 barrier for the first time. The climb now for the last $500, 25 to 3,000, took just 210 days. A stark contrast to the previous $500 increments, which historically averaged more than 1,700 days. Now, gold's rise is no longer gradual, it's gathering speed. Now, the analysts at JP Morgan have divided the gold era, modern gold era, into three regimes, three periods. Let me put this out. First, as a pure inflation hedge from 1970s to 1990, then as a mirror against real US bond yields, 2000 to 2021, and now a geopolitical safe haven driven by central banks pivoting away from the US dollar. And of course, you could add a fourth one. There is Trump driving an American breakup from the rest of the world. Let's take it one by one. The first era, in the 1970s and 80s, gold was all about inflation. When inflation expectations surged, and they surged to 8% in the early 1980s, gold prices exploded eightfold. But once Paul Volcker, the then Fed chair, crushed inflation with aggressive rate increases, gold prices collapsed. Now, from 2000 to 2021, this is the second era, the second regime, survey-based 10-year inflation expectations remained largely anchored between 2 to 2.5%, while real gold prices increased significantly. Now, this was a new dynamic, a newer relationship. Now, the relationship between gold and US treasuries is rooted in the competition between two so-called risk-free assets. Gold, which offers no yield, becomes less attractive when real yields on longer-dated US treasuries rise because the opportunity cost of holding gold increases. Conversely, when real treasury yields fall, gold becomes more appealing, more valuable as a store of value. In the 2 decades starting 2000, gold consistently showed a strong opposite inverse relationship with a 10-year US real treasury yield. And this is the third stage then, the rupture. In 2022, US and its allies froze $300 billion of Russia's foreign reserves. This shocked the world. Suddenly, holding dollars or euros or other currencies, paper currency, wasn't just about economics. It carried geopolitical risk. Since then, central banks have turned into super buyers of gold, price insensitive. Price matters little, securities matters a whole lot more. Adding to this, the US under Trump 2.0 has moved towards isolation, America first foreign policy, pulling back from alliances like NATO, the United Nations, the World Trade Organization, and of course, as I described earlier, weaponizing sanctions as well. This has reinforced the instinct amongst many nations to diversify their reserves, and gold is the fallback. The result, a historic buying spree surge. Central banks used to buy around 400 tons of gold per year. In 2022, they bought more than 1,080 tons, the highest on record then, and they kept going. 1,051 tons in 2023, another 1,045 tons in 2024, and this year, 2025, has started no differently. Today, central banks collectively own around 36,000 tons of gold, nearly 18% of the total reserves. That's a sharp jump higher from 15% just a year ago. 3%, right? But it's happening at the highest levels of global finance. It's meaningful, it's chunky. Meanwhile, you can ask the question, is supply of gold keeping pace? The answer is no. Mining output has been flat since 2018, constrained by falling ore grades, rising extraction costs, and stricter environmental regulations as well. In short, you got demand, which is strong, central banks are big buyers, supply is constrained as well. Just a factoid, right? Interesting factoid, just to remind us that gold is rare and that scarcity drives value as well. If you look at all the gold which has been mined through human history, it's about 2 lakh tons. It's enough to cover a soccer field, but only to a depth of 1 meter. And most of that gold is with us right now. To conclude, what we are witnessing is a true gold rush 2.0, not fueled by just inflation, fiscal deficits, paper currency debasement, etc., but by geopolitics, trust and fear. In a world where financial assets can be frozen overnight, gold once again is the ultimate fallback.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.